In this episode, we talk about how student loan forbearance impacts your ability to buy a home. Let's get started.
Are your student loan payments or loan balances a major obstacle in your financial life? Then tune in and let's escape student loan debt.
Hello, and welcome to this week's episode. If you are looking and you happen to be one of the people who watches us on video when we release episodes, you'll notice over the last few episodes that my location and the structure of the room has been changing frequently. If you would just bear with us, you can see a big light behind me. I'll kind of rotate the camera to see some stuff that you'll be able to see that we're doing on us. We are in the process of trying to make this a much more visually appealing watch in terms of having a real studio and a better camera and all of that. We are about 2 episodes away from having something in place that we think is worth watching. But I would ask that you bear with us for a couple more episodes, but a newer, better visual experience is on the way. I'll tell you why we're doing this episode this week, and it's not one that I think will take a very long period of time. And it's not one that I thought I was going to be doing at the beginning of the week. I had a different type of episode in mind, but then we had a session or had a question that pop up, as often does, that kind of lets us know the temperature of what's going on with people in our community and some things that they may be considering. That question was centered on home buying with federal student loans, and in particular, how the home buying process is impacted based on the current status of your student loan payments. And the reason that I think this is timely, number one, somebody asked the question, but also if you're paying attention to the news, mortgage rates are dropping. They are not and will not get back to where they were in 2021, 2022, but they're definitely going down. And there are a lot of people who were on the fence in terms of buying a home who now are considering it again, and they want to know what the structure of their loans will do in terms of the impact. So let's talk about it. We've talked about home buying on the podcast in the past, but I want to make you all aware of what's important when you're going into a home application process. There are two main things that will impact the structure of your home loan and also the size of your home loan. The first is the structure, and that's impacted by your credit score. So, a lot of people look at buying a home and they think that the only thing that they need is to have a strong credit score. And all credit score does is first make sure that your credit is strong enough to be approved for a home loan, period. And then, based on the strength of your credit score, your interest rate is determined. So, for example, a person with a higher credit score might be positioned to get a 5.5% interest rate on their mortgage, whereas someone with a lower credit score might have a, say, 7% rate on their mortgage. You'll also see some differences if you don't put a large enough down payment on your home and you have to have PMI added to your mortgage, which is essentially insurance that your lender takes out in case you default on your home loan. So you pay it, but it doesn't protect you. If you have a better credit score, you typically will pay less than someone who has a worse credit score. But when it comes to what credit score impacts, it has nothing to do with the size of the loan. It's all to do with the structure of the loan. Now, that doesn't have anything to do with student loans. But what does have to do with student loans is the second major element of buying a home, and that is the debt to income ratio. And debt to income ratio is an expression of how much of your monthly income is swallowed up by your monthly bills. The easiest math I can give you is if you have $10,000 worth of monthly income and $5,000 of monthly debt payments, you have a 50% debt to income ratio. We're actually going to put an article in the show notes that kind of gives you some rules of thumb, even though I'm loath to share rules of thumb. But if you're looking on screen, you're looking at an article from Bankrate, and it gives you some guidance in terms of what's a good, average, or poor debt to income ratio. When it comes to lenders, most are going to want you to be below 36%. 36 to 49% is okay, where you may be able to be approved for a home loan, but it's not ideal. And then above 50% is typically where you start to see people get declined for the type of home for which they're applying. And your debt to income ratio can be the difference between you qualifying for the amount of mortgage that you actually need to buy the home that you're looking for, or whether your lender says, hey, we just can't approve you for that much additional debt. Here's how much we can approve you for. And it ends up just not being enough to buy a home in your area, which happens all the time in Nashville and any other market that has become very, very expensive over the last few years. So now that you understand the guidelines, hey, I got to stay below this amount, otherwise I may not be able to be approved. Let's talk about income-driven repayment plans and how they're treated when it comes to your debt-to-income ratio. It's very important because remember, one of the major features of income-driven repayment plans is that the payment that you make is not necessarily connected to the amount you owe in student loans. So you could have someone who owes $500,000 in student loans where based on their income, they're only making a payment of $75 a month. Is your lender, if you're looking for a home, going to honor that $75 a month, or are they going to use a different higher payment based on how much student loan debt you actually have? It's a great question. And thankfully enough, I have the answer for you based on most major loan types that you'll find in this country. Going back to the article, you will see Fannie Mae, Freddie Mac, FHA, VA, and USDA loans, especially when it comes to first-time homebuyers. They are typically going to fall into one of these camps. However, if you're not falling into one of these camps, you might have what's called a non-conforming or a non-traditional loan. And in that scenario, they're going to have their own guidelines as to how they treat federal and private student loan payments. But no matter the loan type, you'll find two similar threads. Your lender is either going to honor the actual payment you're making under an income-driven repayment plan, or they're going to use a percentage of your total loan balance to constitute your monthly payment. Let's look at the different examples. For Fannie Mae loans, the lender will either honor the monthly student loan payment as listed on your credit report or student loan payment, or if your loans are deferred or in forbearance, they will use 1% of your monthly balance. What does this mean? It means that if I owe $200,000 in federal student loans and I'm making a $50 payment that's either shown on my credit report or my student loan statement, when calculating debt to income ratios, Fannie Mae lenders will use that $50 if I'm actually making that payment at the time. But if I am in forbearance or deferment, instead of using that $50 payment, they're going to look at my $200,000 loans and they're going to take 1% of that amount, which is $2,000, and that's what's going to be used as my monthly payment. If you're putting two and two together, if you're right on the cusp of qualifying for a home loan, there's a huge difference between them using a $50 payment to calculate your debt to income ratio or a $2,000 payment to calculate your debt to income ratio. With Freddie Mac loans, it's similar with a slight difference. They will honor the monthly student loan payment as listed on your credit report or student loan payment. However, if your monthly payment is reported as zero, they will take 0.5% of your loan balance and treat it as your monthly payment. How could that happen? Let's say, for example, we have a person who is a new graduate and they signed up for an income-driven repayment plan in their first year after school, and they're making a great salary. They're making $75,000, $80,000 a year, but when they signed up for a student loan payment, they used their previous year's tax return when they were making $0 in their last year of school. Well, based on that $0 in the tax return, they qualified for a $0 payment. Or it doesn't even have to be that extreme. It could be a person who got a significant pay raise this year, but last year their income was low enough that their income-driven repayment plan offered them a $0 payment. Well, that's a great deal when it comes to federal student loans and what you have to pay. But in that scenario, let's go back and assume that they have $200,000 worth of debt. Even though their income-driven repayment plan is zero, and they're not in deferment or forbearance, their lender is going to take 0.5% of their balance, in this case, $1,000, and use that as their monthly payment. Another scenario that can prevent you from getting a home loan if that's the number that's used. Next up, FHA loans work exactly like Freddie Mac loans. They will take the monthly student loan payment as listed on your credit report or student loan payment, or if your monthly payment is reported as zero, 0.5% of the balance. VA loans work a little bit differently. They will take your monthly student loan payment as listed on your credit report or student loan payment, or 5% of your balance divided by 12 months, whichever is higher. And if they are deferred, they're not included in underwriting at all. Now that's very different. So let's use our example again. Let's say that we have the person who has $200,000 worth of student loans and they're making a $50 payment. Well, the VA is saying they're going to take 5% of those loans, which is $10,000, and they're going to divide that $10,000 by 12 months. That's $833 a month. So they take $50 a month that you're actually paying and $833 a month, which is 5% of their student loan balance divided by 12, and they use the higher of the two payments. So in this example, they're going to use $833, even though you're technically making a payment. If it is deferred, however, unlike the Fannie Mae loans, where when it's deferred, they will take 1% of your loan balance. With the VA loan, if your loans are deferred, they won't include that student loan in the balance or calculation at all. And then lastly, with USDA loans, they'll use your monthly student loan payment as listed on your credit report or loan statement. But if your monthly payment is recorded as zero, they'll use 0.5% of the balance. So if you're looking at this, USDA, FHA, and Freddie Mac use the same guidelines. Fannie Mae and VA use radically different guidelines. And when you're applying for different home loans, you're going to see that there's a big difference in terms of the strategy that you use for your student loans based on the loan for which you're applying. So where does this all put you? Well, if you're looking at all this information, one of the things that becomes very clear is your strategy for your student loans is going to greatly depend on the type of mortgage for which you're applying. And there are a lot of people out there right now who are in Save Forbearance, and they're not required to get out of Save Forbearance. We talked about this in a previous episode where there's interest accruing on your debt, but you're not yet required to make payments. You can leave your loans there in that status as you see fit. However, as you can see, based on the type of loan requirements, it may work to your detriment to keep it in forbearance, at least when it comes to buying a home. If we're looking at this example and we're saying, hey, this person is going to be able to come out of Save Forbearance, and even though they don't have to make a reasonable payment, that might be a better alternative than leaving it in forbearance and having your lender take a percentage of your loan balance to constitute your monthly payment. You have to weigh those different types of decisions when you're trying to figure out, does it make sense to just like get off the fence and start making payments right now versus staying in forbearance because there's a larger benefit to not making payments? If you're not applying for one of these types of loans, you can ask your lender for, hey, what are the guidelines when it comes to federal student loans that are in forbearance? You may find that with your particular loan, they don't even consider it in your debt to income ratio if it's in deferment or forbearance on your credit report. And then you'd have the best of both worlds. You can have it not impact your debt to income ratio while also not having to make a payment. You would just need to make sure that you are applying for a reasonable amount of coverage and know what your eventual student loan payment would be so that you don't get into that home and the second your student loan payments start again, you're immediately house poor and unable to have any room in your budget. If you're already on an income-driven repayment plan and you're in the market for buying a home, this lets you know and gives you some comfort that most mortgage types will allow you to use that income-driven repayment plan that's listed on your credit report. But it also drives home the importance of knowing how to manipulate within the rules your payment so that it's as low as possible when it comes to apply for other forms of finance. But the two overarching points that I hope to drive home in this episode is, number one, as I share all the time on our separate, unrelated podcast, the New Money, New Problems podcast, there's nothing that you do in your life financially that occurs in a vacuum. Everything that you do impacts another area of your finances somehow. And with federal student loans and home buying, this can be seen very easily, right? You can't just make a decision and think that it wouldn't impact your process of buying a home. And knowing the rules and asking the right questions could be the difference between you getting declined for a reason that you don't understand and having a full strategy in place that positions you as best as possible to not let your student loans get in the way of the rest of your financial life. The goal of this podcast is to have your student loans forgiven, reduced, reorganized, or expedited. But we also want to make sure that you don't let your student loans drive the bus, right? It's a part of your journey, but you don't want it to be the thing that dictates all of your financial decisions. This is just one example of how understanding the rules may position you to do something that on its surface doesn't seem to make sense in your student loan journey, but in the totality of your finances allows you to continue pursuing wealth.
From Escape Student Loan Debt, this was the Escape Student Loan Debt Podcast, a show for established professionals whose student loan payments or loan balances are impacting their marriage, their business, their credit, or their dream of achieving homeownership.